Hello, Razorback athletes. I'm Dr. Tim Yeager from the Finance Department, and I will share with you some business and finance essentials if you are thinking of starting your own business someday. That day may come sooner than you think, given the new law that allows you to promote your name, image, and likeness. I will share with you my business idea I would have implemented back in my college days when I was a star athlete on the intramural badminton team. I've got a great idea. I'm excited that the local bakery wants to use my image to sell their cupcakes, though it's a little weird seeing my face plastered on the icing. But they will only pay me 10 cents for each cupcake they sell. My friend says she'll go into business with me to start our own bakery, and we're going for it. Here is the plan we discussed over the weekend. The bakery will open January 1 of this coming year. Each cupcake costs $2 to produce and sells for $10. We sell 10,000 cupcakes per month and earn $80,000 in profit every month. We are going to be rich. Wait a minute, a $10 cupcake selling 10,000 per month? Maybe we better evaluate these projections more closely. Fortunately, I have a friend who's a business major who told me something about a business plan. A business plan is a tool to organize your ideas, strategies, and projections about your business. It's often used as a pitch to investors to obtain financing. Some of the key sections in the business plan include the products and services that will be produced, the marketing plan, the operational plan, management and organization. All these are very important, but we're going to focus on financial planning. After more research of our market and competitors in the highly competitive cupcake business, my friend and I now expect to sell 100 cupcakes a day, or 35,000 cupcakes in the first year at $3 each. We will double sales in the second year. We have to spend $1.25 in variable costs, which are the direct costs to make each cupcake, including things like the ingredients and even the labor that's involved when you are actually producing a cupcake. But we'll also incur fixed costs, those costs not directly related to making a cupcake, and those will be $90,000 in year one and again in year two. Finally, we have to invest $25,000 in baking equipment in the first year. To be financially viable over the long term, a business must do three things. First, it must differentiate its product from competitors to gain market power. Second, it eventually must earn consistent profits either through increased sales, higher prices, or lower costs. Third, you must have sufficient cash available to meet expenses, either by generating cash from the profits of the firm or obtaining additional financing. Well, the nice thing about my business idea is that our cupcakes are different from competitors because they look like me. No other bakery can offer this product without my consent, giving our business market power. Even if new competitors emerge, our product will still be unique. Will we eventually earn profits? To see that, we have to put together a net income statement for years 1 and 2. In year 1, sales will be $105,000 and the variable costs of making cupcakes are $43,750, giving us a gross profit of $61,250. We're going to have overhead expense of $90,000, and my accountant tells me that even though equipment costs $25,000, we can only depreciate that over time, and so there is a $5,000 expense in the first year. Unfortunately, we have a loss of $33,750 in the first year, but in the second year, because sales doubled and our overhead costs stayed the same, there is a net profit of $27,500. A helpful business tool is what we call break-even analysis. It answers the question of how many cupcakes we need to produce in a given year to break even. At this level of production, net income will be zero. To do this calculation, we set total revenue equal to total costs. We know that total revenue is 3 times the quantity of cupcakes that we sell. Total costs are the variable costs plus fixed costs. They include the $1.25 cost per cupcake plus fixed costs of $95. We then use algebra to solve for the quantity and arrive at a value of $54,286. To break even, we must sell 54,286 cupcakes. However, our projections are that we will sell only 35,000 cupcakes in the first year, which is why we project a loss in year 1. Will we have sufficient cash available to meet expenses? Well, to analyze that question, we look at something called the cash flow statement, which shows where our cash goes and where it comes from in a given year. So we start with a zero cash balance at the beginning of year 1. We know that the negative net income in the first year will lead to a cash outflow of $28,750. We also know that we must spend $25,000 on equipment, and therefore we're going to need a minimum of $53,750 of cash inflow just to cover the expenses. To have some cushion, we project that we need $60,000 in cash, giving us a small cash balance of $6,250 at the end of the year. What my friend and I would ideally like to do is to invest $30,000 each into the business, which would become owner's equity in the business. Will the bakery be solvent after the first year? Another critical financial statement is the balance sheet, and it lists our assets and liabilities and owner's equity. The foundation of accounting is that assets must equal liabilities plus owner's equity. This balance sheet shows where our business would stand at the end of the first year. We would have cash of $6,250 and equipment that's worth $20,000 because of the $5,000 depreciation during the year, for total assets of $26,250. Because we didn't borrow any funds, we don't have any liabilities, and our owner's equity is the full $26,250. Our business is solvent because owner's equity is positive. Even though I'm a star athlete on the badminton team, I don't have a lot of money. It's unrealistic to think I could come up with $30,000 to invest in the business. My options are either internal financing or external financing. With internal financing, the current owners fund operations with personal funds or profits from the business. The advantage of this approach is that the owners keep full control of the business decisions and the revenues. External financing comes either from debt or equity. Perhaps we could borrow half the needed funds from a bank loan if our business plan is convincing. Although we would owe legally required principal and interest payments, the interest expense is tax deductible, and the bank would not own any of the company. We could also issue equity by selling shares of the company to non-current owners. The advantage with equity is that there are no required principal and interest payments. Even though dividend payments are expected as the business becomes profitable, they are not legally required. However, selling equity dilutes ownership, control, and dividend payments. Most small businesses just starting out should opt for a combination of internal financing and debt. Don't give up ownership so quickly unless it is absolutely necessary to do so. In conclusion, plan your business idea and the finances carefully with the same intensity you bring to preparing for your next sporting event. Project the net income, cash flows, and the balance sheet. Determine the internal and external financing needs. And don't give up ownership and control unless absolutely necessary to meet the need for financing. Well, thanks for watching today. Be sure to view my latest video on how professors like me could profit from NIL as well as athletes.